Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the money games corporations play. And today we're diving deep into a very specific kind of financial report for a Fidelity fund. It is quite the chunky document. It is pretty wild how much information they pack in here. It's like a financial dictionary came to life, but don't worry, we will break down the most important parts that actually matter. Alright, let's get right into it with the Fidelity Strategic Dividend and Income Fund. Now this is an annual report for the year ending the 30th of November. 2025, think of it as a yearly checkup for the fund to see how it performed and what it was up to. You can always find more details about the fund if you want to dig deeper, but we're here to give you the highlights. First, let's talk about costs. For every $10,000 you might have invested in this fund, you would have paid about $64 in costs. That is a bit less than 1%, actually 0.62%. For the main fund share class, it's like paying for a small subscription fee for the year. Now for the juicy part, what made this fund bounce around like a pinball? The report says that for the year leading up to November 2025, big picture things were looking good for investments. The economy was resilient and interest rates were starting to drop, which is generally good for businesses and stocks. Within the fund itself, the big win came from picking dividend-paying stocks. That is where companies share some of their profits with shareholders. The fund did especially well in industrials, information, technology, energy, and healthcare sectors. They also made smart moves with convertible securities, which are like bonds that you can turn into stock. But it wasn't all sunshine. The fund took a hit when it came to real estate investment trusts or REITs. These are companies that own income-producing real estate. Picking the wrong REITs in retail real estate related and specialty areas really hurt the fund's performance compared to its benchmark index, which is what it uses to measure itself against. Okay, let's look at the long term. If you put $10,000 into this fund back in November 2015, by November 2025, that $10,000 grew to over $24,000. That is a pretty solid growth of more than double over 10 years. Compare that to the S&P 500 index, which would have turned that $10,000 into almost $40,000. So while the fund did well, it didn't quite match the broad stock market. Looking at average yearly returns, the fund delivered about 6.95% over the last year. Over 5 years it averaged 9% annually, and over 10 years it was about 9.22%. Again, the S&P 500 index saw much higher average returns, especially over the last year at 15%. The fund itself is quite large, managing over $5.3 billion. That is a lot of money from investors. It holds about 709 different investments. The total advisory fee for managing all this money was over $32 million. That is a big chunk, but typical for a fund this size. Now, what did the fund invest in? As of November 2025, the biggest chunk of their money, about 17.4%, was in financials. Real estate was also a big focus at 16.6%. They also had significant investments in information technology and healthcare. Over half of the fund's investments, 51.5%, were in dividend-paying equities. This aligns with the fund's name and strategy aiming for income. Convertibles and REITs also made up significant portions. Geographically, the fund is heavily invested in the United States, making up over 92% of its assets. This means its performance is very tied to the US economy. Looking at the top holdings, the fund had significant stakes in big companies like ExxonMobil Corporation, about 2.9% of the fund's assets, AbbVie, Incorporated, and Procter & Gamble Company. These are well-established companies. Now, this report is for different share classes of the same fund. For example, the Class Z shares had a slightly lower cost of about $57 per $10,000 investment. The Class Z shares have a shorter history starting in October 2018. If you invested $10,000, then it grew to about $17,400 by November 2025. That is an average annual return of around 9.07%. Which is pretty good. Class M shares had higher costs at $120 per $10,000 investment. This is because they often come with a sales charge. Over the past 10 years, Class M shares with sales charges would have turned $10,000 into about $22,000. Without the sales charge, that $10,000 would have grown to almost $24,000. The annual return for Class M shares without the sales charge was around 8.64% for the 10-year period. Finally, Class A shares had costs of around $95 per $10,000 investment. And if you invested $10,000 in Class A shares with the sales charge back in 2015, it would be worth about $22,000 today. Without the sales charge, that amount would be closer to $24,000. The average annual return for Class A without the sales charge over 10 years was about 8.91%. Now for a quick look at the auditor PricewaterhouseCoopers LLP or PwC, this is the firm that checked the fund's books. For the year ending November 2025, the fund paid PwC about $54,500 for audit fees and another $6,700 for tax fees. For the previous year, almost identical amounts. When you look at fees for the whole Fidelity group and services related to them, the numbers get much bigger though, over $13 million. This just shows how much work goes into keeping these giant funds compliant. This next section is the heart of the report, the financial statements themselves. It is packed with tons of data, very detailed, look at where all the money is and where it came from. When you look at the schedule of investments, it details every single holding. For example, they held some bank loan obligations representing 0.0% of the fund's net assets. They held over 54% of their investments in common stocks. Breaking that down by country, they had about 2% in Canadian companies. Within Canada, they invested about 1.1% in energy companies like Canadian Natural Resources. Back in the US, they had a huge portion in communication services stocks, about 47.4%. And remember that ExxonMobil holding we saw earlier, it was valued at over $151 million, a pretty significant chunk. The fund also held 13% of its assets in convertible corporate bonds. This means they invested in bonds that can be converted into company stock, increasing their potential upside. They also had 1.9% in convertible preferred stocks, which are similar but have different features than common stocks. Interestingly, they also invested heavily in their own domestic equity funds, specifically the Fidelity Real Estate Equity Central Fund, making up 15% of the total assets. This is like an internal investment strategy. They had a smaller portion of about 0.9% in traditional, non-convertible corporate bonds, and a significant 9.9% in non-convertible preferred stocks. These are a bit like bonds but represent ownership in a company. Finally, a small portion, 0.7%, was kept in money market funds. These are super safe and liquid investments generally used for short-term cash management. Altogether, the fund had almost all of its assets, 99.8%, invested in securities. Its total cost for all these investments was just over $4.1 billion, but their value at the end of the period was over $5.3 billion. That is a gain of almost $1.3 billion on their investments before considering expenses. Looking at the balance sheet, the fund's total assets were almost $5.4 billion. Liabilities were much smaller, just over $7 million, so the fund's net assets were just shy of $5.4 billion. The net asset value per share varied slightly across the different share classes. For the main strategic dividend and income shares, it was $18.65. For Class A, it was $18.46, and for Class Z, it was $18.58. These numbers show the value of each share of the fund. Now for the profit and loss statement. For the year ending November 2025, the fund earned over $158 million in income from dividends and interest. Expenses were around $38 million. The big story here though is the gain on investments. They had over $282 million in net realized gains from selling investments. This is where a lot of their profit came from. However, they also had a change in unrealized appreciation of negative $65 million. This means some investments lost value on paper during the year. Overall, the fund's operations increased its net assets by over $337 million for the year. Investors received over $268 million in distributions from the fund during the year. This is how the fund passes on its earnings to shareholders. Finally, the report discusses the board's approval of the management contracts. Essentially, the trustees reviewed the services provided by Fidelity, the fees charged, how they compared to competitors, and the profitability for Fidelity itself. They decided to renew the contracts, believing the fees were fair and reasonable given the services provided and the fund's performance. They also noted that the fee structure allows shareholders to benefit from economies of scale as the fund grows. So what is the story here? The Fidelity Strategic Dividend and Income Fund had a solid year in 2025 thanks to strong market conditions and smart stock picks with dividend payers. However, it lagged the broader S&P 500 index, indicating that while it is a good income-focused fund, it might not offer the same growth potential as a pure broad market index fund. Its heavy investment in US markets makes it sensitive to US economic trends. The fund's size and complexity with multiple share classes and significant investments in affiliated funds mean there is a lot going on behind the scenes, but investors seem to be rewarded with steady long-term growth, even if it is not explosive growth. The costs are reasonable, especially for the lower fee share classes, and the board seems to be actively overseeing the fund's management and fees. Now, looking at these numbers more broadly, Fidelity's Dividend and Income Fund appears to be a steady performer focused on generating income and capital growth through dividend stocks and bonds. It is well managed with a clear strategy, and its substantial asset base and diverse holdings suggest a degree of stability. The main risk comes from its heavy reliance on the US market and the potential for underperformance relative to broader market indexes during strong bull markets, like the one experienced in 2025. Alright, that is our breakdown of Fidelity's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to join our Discord community linked in the description below. Thanks for watching. See you next time.